The more I get into this, the more I realize the way to make money in the stock market is to identify companies that are growing. And a company that is growing is increasing its revenue year after year. If it's going to grow exponentially, it's going to increase its revenue by 20% or more year after year. If it will do that, it will learn how to make profits. If it makes profits and grows those profits, you and I will buy their stock as it goes into higher and higher levels. So as an investor, all I have to do is find a company that is growing their revenues. There's only three elements to a company's success, and that is revenue, revenue, and revenue. If they aren't growing their revenue, they're going to become stagnant. So Amazon is a excellent example. I explained it to you yesterday. They IPO'd, and then they did not make any money for 7 years. But in those 7 years, they consistently grew their revenue in excess of 20%. As they did that, their price went up accordingly. And then after 7 years, they started showing profits. So as an investor, all I have to do is go into the stats, the data, and find the companies that over the past 3 years have been growing their revenues in excess of 20%, and then projecting into the future are growing their revenues by more than 20%. Then if I go over and look at how are they growing their earnings per share, that will confirm that this is a company that is going to grow exponentially. It's going to grow faster than the market, and faster than the best stocks in the market. It's going to grow faster than Amazon, Google, Apple, and Microsoft, because more than likely, if it's growing its revenues by more than 20%, it has not matured yet. It has yet to tap into the full potential of the three ways you can grow a company. There's only three ways. One is to expand your TAM. That is to say, increase your total addressable market. We saw Facebook do that. They expanded into India and exploded their TAM. Netflix did the same thing. Netflix now shows more movies in Europe than it does in the United States. They expanded their TAM, and so they grew. This is the same for every company. I mean, Elon realized in order to grow Tesla, he was going to have to sell cars in China and Germany and Europe. So he expanded his TAM. The other way to grow is to increase your price. Netflix has continually done that, as has Amazon. And then the third way is to develop a new product. Well, we are developing a new product called AI. So we need to we know that Amazon, Google, Apple, Microsoft, and Tesla are going to do us well, and they are going to be the key parts of our portfolio. But we have to then go find the companies that are in the early stages that are showing the growth in the three most important things in our analysis. And that's revenue, revenue, and revenue. So that's what I've done. I've gone and searched the data to find the companies in my growth area, AI, semiconductors, who are growing their revenue past 3 years in excess of 20% per year, future projections in excess of 20% per year. And then I'm adding a bonus as to what are they projecting their earnings to be, their earnings per share. Is it growing as well? If I can do that, I can come up with the Amazon, the Netflix, the Google, the Tesla of the next 3-5 years. Let me show you where I bring this all into focus so it's easy for me to see who is going to be the big growers through fundamentals and through what are the three most important things? Say them after me. Revenue, revenue, and revenue. If I don't grow my revenue, I die. Let's go to Kerry's tell sheet, and it tells everything. Okay, this is my tell sheet. Tells me everything I need to know for me to make good financial decisions. This is not financial advice. I'm just sharing with you how I manage my portfolio. If you want to know more about it, I'll tell you how to do that before we finish. So what I do is I list the 62 companies that I believe are going to potentially be the big players in the AI revolution. And I think that's where the big growth potential is over the next 3 to 10 years. So with that in mind, what I do is, as I said, I look at their revenue. Let's jump over to here. This is my revenue section. And what I'm saying is, what was their average growth of revenue over the prior 3 years? Then I go and find are they projecting the growth in the revenue to be in the next 3 years. So now I have a 6-year composite, and that's what this is here. This is what they expect. And I have learned from my studies and my analysis to be an exponential growth stock, you need to average 20% growth per year of your revenues to get to where your stock will give you exponential growth. So here you can see I have listed every one of the stocks that I believe are going to be the big players, and I show where their growth is. Apple, in the preceding 3 years, has grown their revenues at an average rate of 3%. They're projecting that to go up to 6%, but that gives me an average growth rate of 4.8%. So if Apple wasn't Apple, I wouldn't buy it. There's nothing there for me. I can't make money at 4.8% per year. Okay, then I come over here and I say this is their average projected growth of earnings in the future. That's 11%. That's good, but it doesn't meet my standard. I drop down one stock to ACLS, who is projecting the growth of their revenues at 70% per year over the next 3 years, have grown their revenues the past 3 years at an average of 20%, and then are projecting to increase that to 23.73% over the next, and I get an average of 21. That meets my standard. Then as I've explained in prior videos, I look at the rule of 40. Rule of 40 is adding this number and this number together, adding the growth of their earnings per share plus the growth of their revenues, and that comes up to 94. 40 is good. So I look at that stock and I say, that's a stock I want to probably buy. I need to learn what they do and where they fit into my scheme of the whole realm of AI. And to do that, I come over here and I go to my deep dive. This is a podcast that I have created, 15 minutes through AI, that will explain to me exactly what ACLS does. Now, this is I will do a briefing, and that is a written description of what they do. And what this is their financial health. All these are created by AI. So as AI develops, these develop further. As they go into their earnings call, the last time I updated this was November the 10th. When they do their next earnings call, these two will be added. My objective is someday I don't have to do this work, that my AI agent, Samantha, will do it every day for me and fill in all of these columns. That's where I'm headed. I'm going to need some help, and we'll talk about that later. So that's what I do. Now, let's look at what is this? Because I don't see the numbers, the growth in Apple that I would like as an exponential growth, but knowing that they are a $3 trillion company and they have to be reckoned with, I will hold it. I will hold what I've got. I'm not looking to buy. I drop down here to Adobe. I'm doing Adobe because in the comments from my video today, someone commented that I bought Adobe after it came down from its earnings, and I think it's a good buy. I want to address that because I think it gives a good example. Adobe is projecting their earnings to grow an average of 12% per year over the next 3 years. But let's look at their revenues. Over the past 3 years, they have grown at 8.66%. They're projecting that they'll grow at 9.66%, roughly 1% greater over the next 3 years, which gives me a growth rate of 6 years of 9.16. Their rule of 40, they achieve half of it. Adobe is a sell. No, they are a sell because they are not achieving what I need to achieve to get exponential growth. I need to see 20% or greater in this column. I get a bonus if I see 20% or greater in this column. I then come over here and again, I add this to my analysis. What is their 52-week high? They are down 34.3%. That's a good gain if they get back to it. But I don't think they're going to get back to it because they're only growing at 9% per year, their revenues. Why is that? Because I can get from Amazon, Google, Microsoft, and AI today what I could only in the past get from Adobe. They are being replaced, in my estimation. So I will sell Adobe. I go through and I do this for every stock. Now I want you to look at, if you did not know what the tickers were, where would you say that's what I want to buy? Look at this. Here's a company that are growing their earnings at an average over the next 3 years at 168%. They grew their revenues over the past 3 years at 247%, and they're projecting that their revenues are going to grow at 99% over the next 3 years to give them an average over 6 years of 186%. Their rule of 40 score is 267%. Their price is $6.95. Their 52-week high is $15.88, and they're 56% off of that. That's a buy. What does Wall Street think? Wall Street thinks it has a 67.46 potential growth over the next 8 months, or over the next 18 months. That's a buy. Currently ranked my number one stock. If you don't know what AIREN does, you come here and you go to the podcast. The podcast will give you exactly in 15 minutes what IREN is. If you'd rather read it to know what it is, there you can download a copy of the briefing. If you'd like to know what their financial history is, that is an analysis of their balance sheet, an analysis of their income statement, an analysis of their cash flow statement, and an analysis of their latest earnings call. What I'm going to add to this will be an analysis of their 10K. So I will know everything about IREN, and it will tell me, do I really want to buy it or sell it? Or do I want to hold it? What is this? This is NVIDIA, projecting growth in their earnings of 29.9% over the next 3 years. This is their growth over the past of their revenues over the past 3 years, 62%. This is the growth projected in the future. Half of that, 31%. This is their analysis of their 6-year growth, 46, but it's cut in half. This is their the rule of 40 score, quite good at 61. This is what they are off their high, 153. I have it rated as a hold. Why? Because of that number right here. Their revenues in the next 3 years are half of what they were in the preceding 3 years. That's what this tells me. That's why it's called a tell sheet. That's what it will tell you. And then you make decisions based on good financial fundamental analysis. And where you start, remember, are the 3 most important elements of fundamental analysis. Revenues, revenues, and revenues. And what did they tell us? Hold NVIDIA. Buy IREN. Okay? That's the message. Buy CRDO. Because their earnings are projected to grow by 221%. Their revenues have grown in the past 3 years by 52%, projected to grow even more over the next 3 years at 69, to give us an average of 61 and a rule of 40 score of 290. That's a buy. You tell me where else you can get this. Now, I haven't rated all of these because I'm going to keep that available to my tribe. My member of my tribe who are part of my group, who are going to say, Kerry, we believe in this. We believe this is more insight into how the stock market works than anything we have ever seen before. And we're willing to help you finance it to get better. And that is to get an AI agent, a computer that sits right here and fills every one of those squares, those cells, every morning. Updates the health of the company every time they have an earnings call. To give me current information from the data that is available that I can access through AI. What I'm telling you in this will only get better as AI gets better. The other thing I'm telling you is I can only manage 60 stocks. I just did this all this week. I did this average growth of revenues for 3 years, 6 years, and average growth and the rule of 40. I have put in 40 hours into this so that I can make better investment decisions. What you need to decide is, do you want to make better investment decisions? That's up to you. If you want to, I'll share this with you. I'm not going to charge you what Jensen and Dell or whoever sells me the AI agent. I'm not going to charge you what they're going to charge me because they're going to charge me somewhere around $10,000. I'm going to have to hire a technician. I'm probably going to have to pay them $150,000 a year. I'm not going to put that on you. I want you to grow with me. So we're going to start out at $19.95. And I'll lock you in. And you'll grow with me. Will it go for $19.95 in a year? I seriously doubt it. It might go for $19.95. $1,995 a month. I don't know. This is what I do. What you see over here, this is my portfolio. I'm not going to show you that because it changes. I'm selling this week those that are no longer meeting my expectations. There's one I sold just this week. SITM has a 59% potential growth in earnings over the next 3 years. So then why am I selling it? Because its earnings over the past 3 years were 27%, or a negative 8%. They're projecting 27%, and that gives them an average of 9, and their 40% rule is at 6, but this doesn't meet my standard. When I can get in Nebatas 220, or I can get in Iran 99. I have better options, is what I'm telling you. Now, the other thing, what I do here is confirm how do the analysts feel of this. So now you can come over in here and say, well, Kerry thinks ACLS is good, but I think it's a dog. Well, Wall Street thinks it's going to go up 33% in the next year to a year and a half. So I share that this is their analysis combined with my analysis, and then I'll tell you what I'm going to do. Buy, sell, or hold. If I'm going to do anything. Some of them I'm not going to buy. Okay? This is what I want to share with you. If you'd like it, you know how to get it. Go to Best of Us Investors or go into the description, find the link, and sign up for $19.95 a month today. I don't know what it will be after the world figures this out, that Kerry in Best of Us Investors has got the key to your financial future. We'll talk more about this in the future.